Which one of these is going to get hurt more with a very severe down move? Is a question I like to ask. The one that's closer to my advantage, if I'm at the money, it'll get hurt less with a severe down move. And the reason for that is because of the way volatility shifts. You're going to get a skyrocket in the short strikes here. If you get a 40-point down move in the Russell tomorrow, these are going to skyrocket in volatility. The volatility in this one isn't going to do a whole lot. The volatility in this one, it might skyrocket, it might not, but the reality is there's so little actual underlying value in it. Remember, implied volatility is a percentage of what an underlying value is, and the underlying value is whatever's near the money. This one may not increase in value that much. It's caused a big depression in the T+0 line here, and you can get some huge loss numbers, much more than you expected. This one here, by the time the price gets down here, these longs are going to end up having a lot of underlying premium in them, and combined with a volatility spike, and it'll actually a lot of times raise the expiration graph down here. So you get in a phenomenon where this is getting crushed, and the more you do that, if you start getting into, this thing where you really
hey John.
Yeah.
So this is the case where when you're looking at if you were to just look at the graph that you just showed, in other words, you can't believe what you see.
You're right. You can't believe what you see.
Somebody would look at that graph and say, John, what are you talking about? Because it's saying just the opposite.
Right. The graph is saying the opposite, but you need to understand how the volatility, where the volatility is going to pop when the price moves, and what the underlying values in these options, the time premiums in these options are going to be when it actually happens.